Hello, this is Dr. Adam J. Bock. We're going to continue our conversation about finance. In this presentation, we'll talk about equity financing, provide a short introduction to valuation, distinguish between angels and VCs, and talk just briefly about due diligence. Equity financing is in itself a relatively straightforward concept. The idea is that investors purchase stock, ownership in your venture, which provides cash for the business. The purpose is really straightforward as well. The goal is to grow the business very, very rapidly. And the reason that you would potentially do this is because, for example, let's imagine that you sell 90% of your company to generate the funds you need to grow to a $100 million value company. Well, 10% of that would be $10 million. Well, that's worth a lot more than owning 100% of a $1 million company. And so the idea is that if you can grow the business quickly enough, it makes sense to sell ownership in it because your stake continues to grow fast. Keep in mind that equity investors are primarily interested in generating above market returns. So they're not going to invest in your company if they think that they could get the same kind of return on investment by investing in something like Walmart or Apple. So these kinds of companies that seek equity funding have to be able to demonstrate that they're going to grow very fast, much, much faster in terms of revenue or value than the overall market. Some thoughts that you need to consider. Number one, you need to resolve any founding team ownership issues in advance. You can't enter a funding round and not have resolved who owns what. There are multiple phases of equity financing, sometimes pre-seed or seed funding followed by Series A, Series B, Series C. But there are no hard and fast rules or definitions for exactly how big these rounds are or when they happen. The book suggests a certain phasing of these kinds of investments, but it depends on where you are in the country, the industry you're in, the prior success of the founders, and so on. Everything in a funding round is negotiable, right? So people sometimes arrive, especially new entrepreneurs, into the funding process thinking that there are some pretty straightforward things to consider. But the deal is whatever is negotiated, and it's often negotiated based on how easily people can walk away from completing the deal. So your ultimate goal in doing equity financing is an exit of one kind or another, either via acquisition, which is the most common best case, or an IPO, which is pretty unlikely. So for each year, there's more than 500,000 new companies formed in the United States. Less than 1% of them will achieve outside equity financing, and only about 150 or 200 companies a year reach IPO. So we're talking about a very, very small portion of companies that either get equity financing or ultimately get listed publicly. A side piece of equity financing is generally referred to as convertible debt. And you might be interested to know there's a new variant on this called a SAFE, generated by the folks over at Y Combinator, which is not even convertible debt. It's technically an advance on future equity. But the idea behind either of these is that you're accepting a loan, which is then converted to equity at a future point in time. This is used to protect the investor on the downside, especially in situations where it's really hard to value a company. You know, as a venture gets started, it may not have a lot of assets, it may not have a lot of intellectual property, and so placing a value on it can be highly problematic. The kinds of terms that are used for convertible debt, an interest rate in theory, some type of term for the debt and a trigger for conversion, and then a conversion rate. Does it convert directly into the equity at the same price as the new investment round, or does it convert at a discount? So it's useful to see the distinction in how this happens. This is a little bit of a hyperbolic example, but it really kind of makes the point. So we'll talk about valuation in just a moment, but for right now, imagine we have a company where we think that the company is worth $900,000, and once the outside investor puts $100,000 in, it'll then have a post-money valuation of $1 million. In that situation, the outside investor is getting 10% ownership. 10% of $1 million is the $100,000 that they invested. But the day after that investor makes the investment, the founder sells the company, except that she sells it for only $500,000. So what happens? Well, if that investor had put that in as a common equity investment, the founder would get $450,000. That is 90% of the selling price. And the outside investor would only get $50,000, which would be pretty frustrating. You put in $100,000 and the next day the founder turns around and hands you $50,000 and the whole thing is concluded and you've just lost half your money. If it was put in as convertible debt, then then it's still technically a loan. And so the outside investor will get their $100,000 back. And this is sort of the base reason why, in many cases, investors very, very early on want to get convertible debt instead of equity in order to try to align incentives with the founder a little more clearly. So now that you've seen that quick example, let's just make sure we're clear about what valuation is. First of all, valuation is a combination of art and science. It would be lovely to say that there was some way to definitively value startup companies, but there just isn't. There's a lot of methods for valuation, none of which are definitive, and some of which are completely and utterly wrong. One of the most common ones to use is comparables. That is to look at other companies that have been funded for which you do know their valuation, and then to apply that in some way, shape, or form to your situation. More traditional valuation mechanisms include net present value of cash flows, which is pretty generally a poor option for startup companies because your future cash flows are highly uncertain. The discount rate is potentially enormous, and so doing that kind of calculation is highly problematic. You could do an NPV of future acquisition value, which is speculative but reasonable. Why? Because you can look at comparable acquisitions. So here are some other companies in the same field as we're in, and these two were bought out for this price. That would give you at least some indication of what your future value might look like if you're successful, and then you can use NPV to track that back. Industry PE ratios are sometimes used, but they're pretty unlikely to be relevant in these situations, again, because your earnings are likely to be either negative or not really indicative of your long-term earnings. And the PE ratio is usually designed around companies that are growing a lot slower than you're expecting your company to grow. So it can be a very tricky one to use. Value created or cost to replicate is very commonly used for formalized valuations. It's great for accounting purposes, but not generally actually very accurate. So it operates on the idea of how much money would you have to spend in order to get the company to where it is right now. So it can be a little more definitive, but it tends to come in with some relatively low numbers. The basic equation for valuation is really straightforward. Your post-money valuation, that is how much the company is worth after the investment, is equal to the pre-money valuation, that is how much the company is worth before the investment, plus the investment, how much the money went into the company. So if you imagine the company being basically a box, and before the investment, the box is filled with certain things, people and assets and knowledge, that's worth a certain amount of money. If you then put more cash into the box in the form of an investment, you've increased the valuation by the amount of cash. So this is the basic equation. It really is that straightforward. And then in theory, the ownership of that investment is the investment divided by the post-money valuation, right? Because that's how much the thing is worth afterwards, and the cash that goes in gets the stock ownership for the investor. So who are equity funders? Well, at the beginning, there's the 3 F's, friends, family, and fools. There's also, once you get past that, angel investors who can be either affiliated, that is, you knew them or they have some connection to the organization. They could be unaffiliated, they get connected up with them and they have no prior connection or link to the organization, or they could be a network or a group. Venture capital is usually a fund. It can also be a strategic partner or an institutional corporate fund that makes investments. So how are angels and VCs different? Angels are using individual funds. They're using personal money. They're just one person at a time. And they usually make individual decisions, often based on their emotions or their gut. Many angels do a really nice job of doing diligence, but the core distinction is that because they're spending their own money, they can make the decision in any way they want. Oversight from angels varies dramatically. Some like to be very involved. Some like to just give you their money and walk away. And angel investments on the whole tend to be less complicated. Venture capital firms have a managed fund. That is, they've gone out and they've raised money from other people, organizations, and institutions. And they then manage that by investing it piece by piece into startup and growth companies. So they have an investment process, and they use a single decision to make a large investment. So with angels, you talk to 20 angels, each one of them is going to make their own decision. That might be, you might need to get 10 or 20 angels involved in order to raise the money you need. When you go to a VC, that VC makes one decision on behalf of all of its investors, and it puts the money in itself. They tend to have very active oversight. They'll want a board seat. They will want regular updates. They may be actively involved in helping select new management and executives, and they will want lots of protection for their investment built into their investment document. That is, if things don't go wrong, they're going to want to take steps in order to try to resolve the situation or to exit the investment as quickly as possible. So closing one of those deals usually involves a process we refer to as due diligence. This tends to be a rigorous process carried out to evaluate an investment opportunity or transaction. The idea here is that we're creating a common information set between the company and the investors. The way this normally works is that the investor will submit a list of questions and document requests of the company, and the company will have a certain amount of time to provide that information, and then the investing group will then have follow-up questions or seek additional information. What it really is it's a basis for avoiding legal action in the future. The company should want to get as much due diligence done so that if things go wrong, they're not likely to be sued for fraud or anything like that. The investors, especially venture capitalists, want to show that they checked as much as they can, because if things go wrong, they don't want to be blamed by their investor group for having missed something. It can cover any and every aspect of the business: finance, human resources, legal, contracts and transactions, IP, and other assets. One of my companies, as it was going through the acquisition process and the due diligence process, it turned out there was an outstanding contract for a copier machine that had never been actually terminated. And that was a short temporary sticking point in the due diligence process, because technically when the company was going to be acquired, the acquiring company didn't want to be subject to that agreement. And so that had, all the documentation for that had to be tracked down, the original vendor had to be found, and the contract had to be terminated before the due diligence could be completed. This can take days, weeks, months, or longer. Traditionally, for a VC investment, we're talking about 1 or 2 months. For an acquisition of a firm, we're likely talking about something closer to 3 to 6 months, more if it's a larger acquisition. So a couple thoughts on private capital for you to consider. It looks easy, but it generally isn't, and almost always takes longer than you expect. The shortest funding round that I ever did was completed in less than 30 days, but we knew the investors in advance. They had been aware of the company and actually providing guidance to the company for months in advance as well, and it was a small round. My recommendation is that you think of your venture as your current gig, not your nest egg, especially if it's your first deal. How do you want investors and other people to remember this? Treat them as if you would like to be able to work with them again. Get expert advice from people who've been through it, and then have a trusted attorney, but use that attorney sparingly, only as needed. Attorneys are expensive, and you can wipe out a big chunk of your investment round just on legal fees. In the end, everything about raising external capital is about risk and control. How much risk are you willing to take, and how much control are you willing to give up? If you don't recognize that trade-off between those, this possibility of growing fast versus giving up control of the organization, then you have no business trying to raise private capital. You can always choose to grow organically. That will keep control, but it does give up your ability to move faster. Remember that your investors are never in this for exactly the reasons that you're in it. Yes, get alignment, try to make sure everybody's on the same page, everybody has the same goals, but don't pretend like your investors are in it for the same reason that you are. And ultimately, when it comes to negotiating a deal, there's no right answer, but there are usually lots of options that are way more wrong than others. So your book does a really nice job of providing additional information about the private capital situation. I'd encourage you to take a careful look at the materials that are available. The textbook has additional resources on finance in the appendices. We can really only touch on this briefly in the context of this course, and in reality, this is way more complicated than it sounds. And so to the extent that you find yourself in an organization that's doing outside capital raising, I encourage you to seek out trusted advisors that you can rely on for guidance in this very complex and legally fraught process.